Hey traders, Parker here with another indicator. Today I'm going to introduce you to the 7 key market ratios. And as you can see right here, it's anchored to this date and I have a momentum of 42 bars. The stock market is basically open up 252 days out of the year. So 42 represents 2 months. I'm going to get rid of the top half of the graph. I'm going to show the indicator by itself because it's in the bottom half of the graph and it gives you more visual perspective on it. So where we have the relationship or the ratios are the percentage change ratios versus the SPY. And you can see SPY VIX, and right now I don't have the VIX plotted. That's just because it gives you a measure of volatility, but at times it overtakes the entire indicator because of the VIX. When it spikes, it changes everything. You can see how everything just becomes so small. But if I zoom in, we can see that current volatility really spiked here on 11/14. And the VIX have been elevated ever since. And we'll do a comparison also on the chart to show you what the S&P 500 did. And you can see this is the down day back here in 10/10 October. And you see how the VIX would stay elevated, or its percent change stayed elevated during this time period. As it went down, the S&P rose, but as it's gone up, the S&P has gone down. So what I'm going to do is go back into that view, and I'm going to get rid of the VIX just because of the way it is. Well, we have our labels down there to take care of that description with the VIX being so, spiking up and not being able to see the indicator. So you can see each one of the lines has their bubbles. You have your risk off spread. That's what this histogram is. And then you have your labels. So you have your labels of SPY versus VIX. You have stocks versus dollar. You have growth versus value. You have small versus large cap. And I also gave you the tickers as well. So offense versus defense. You can see stocks versus bonds. You can see stocks versus gold. And then we have, this is for the S&P 500 stocks that are greater than their 200 day. And there's one for stocks greater than their 50 day as well. I'm not sure why that's not showing right off the bat. Okay, so now we have our stocks above the 50-day move average for the S&P 500 and the stocks above the 200-day move average. And you can see that our stocks that are below the 50-day move average has turned to 0.39 above 59. Above the 50-day move average. But you can see it's turned pink, and pink is saying that it's improving, but it's still below zero. So most of the stocks in the S&P 500 right now are below their 50-day move average. And that goes into our risk on, risk off score over here as well. So you can see right now our score of -3 is neutral, but it's still a negative. So we're going to say it's going to be risk off. And you'll see this label flip from risk on to risk off as well. But right now, what I want to bring your attention to is the back half of the labels. If you look at the back half of the label, it says volatility is leading, saying that the percent change, difference between percent change of the VIX and the S&P 500 is greater. So the VIX S&P is greater than the SPY's S&P percent change. That's why I'm word salad. But anyway, or soup. So, and you have the same thing right here. Even though I put the SPY first, it's actually the Dixie minus the SPY and the VIX minus the SPY. Same situation here with gold. It's actually gold minus the SPY. And here you can see I'm using the futures, the ticker for the gold's futures. And I'm using the SPY, even though it says SPY, I'm using the future SPY as well. So /ES is the future contract for the S&P 500. And so we could come over here, we can see how stocks are weakening versus the dollar. You can see growth is weakening versus value. And you see small caps, where large caps are leading right now. And we have offense weakening and we have stocks weakening. And that's based off of this anchor point. and 42 bars used for momentum. So right now we have a score of neutral, but I would say risk off. But that's using the anchor point, and that's anchoring those stocks percent change from the start of this year. So if I were to go in here and change this to, I want to say, let's say April 4th, when everything crashed, when everything started rebounding. So let's go to, yeah, this is the day everything rebounded. So I'm gonna leave everything on 42, and let's look at it from this perspective. And from this perspective, from that date that all the stocks and everything rebounded, we have a risk off score of neutral just because everything is starting to go down. And you can see how all the labels and everything was changed as well. So what I'm going to do now is change this from the anchor point, which it says the date. We're going to turn to a rolling period. And this is where your rolling period comes in, and your momentum is still in there as well. So if you want to use a 42 period rolling minimal, 42 bar rolling period, I would change my momentum to 25% of that. That's how I've been using it, or you can leave it at 42 as well. And that 42 is just showing you the same difference, that difference between the two over the same 42-day period. And this is what it looks like a rolling. We have a risk off score of -6, a risk score of -6, and that's risk off. So our rolling period for amount of bars we're using, and if you're looking at regular stock, it's just the length. And then we're taking the difference between these, and we're adding another length of 42. And this is where we're getting our risk, our volatility. I mean, the back half of these labels for our momentum. So we can see that these two labels right here are not going to change. They're not going to be affected. So we're looking at it on a daily period. You can also look at it on a weekly period as well. But I'm going to shift this down to the momentum down to 11, because that's what 25% of this 42-day or 2-month period looks like, or is. And we can see everything is basically in the toilet. It's all negative across the board because I'm using 42 days, but I'm using 25% of that length. So I'm going to take it to a weekly time frame, and I'm going to change these. There's 52 weeks in the year, so I'm going to use, let's do it like this. So I'm just going to do 52, and I'm going to use 25% of that. It's roughly 13. And we're going to look at it from this perspective on a weekly. So we're back to neutral again. And this is not going to change. This stocks greater than 50 day and the stocks greater than 200 day, those are not going to be affected by this weekly time period. They're always going to be the same because they're looking at it from a daily time period. So, but now our rolling period is turned to 52 because I'm looking at on a yearly average, and then I want to know what's I'm using 13, which is roughly 25% of that yearly average. So what you're seeing is volatility is still leading in the market. Stocks are still weakening. Growth is weakening, and large caps are leading while small caps are weakening. And you can see the offensive here, offensive, defensive. You have stocks and bonds. You have all these different things. So these are your metrics for your risk on and risk off. And I could switch this to. You can still use your anchor period on this weekly time frame as well. So I'm gonna switch this to, let's say, what is that? Let's say 3, and that'll give us 3 weeks on a quarterly period. And that's basically how you want to use the indicator. Or you could have left this at 13 as well, just to give you an idea of what's the difference, the lengthwise difference. But that's basically when I'm coming and looking at my indicator. So I'm going to shift this back down to. So now we can come here, we can look at the S&P 500 on this weekly level, and I have it pretty fast because I'm looking at it on the 13 week rolling period, and I have 3 for the momentum. That's just showing the difference the between the two down here, the growth versus value, and all these different things. The difference between those set to another length or set to momentum. So we can see right here, this is when everything crashed. I forgot what happened right here, why everything went down, but I know that everything pushed back up afterwards. So the one that I always remember is CrowdStrike, and that happened in April. I mean, not April, but August right here. And we can see how everything was being affected. You can see your risk. These labels aren't going to change, but we can come down here and we can see how risk was on, and then it shifted down to neutral, and then it pushed back above, and it gave us a risk on right there. And this is our standpoint when I was talking about from April 7th. And you can see right there how everything was initially was risk on, then it went to risk off, then neutral, then risk off, and then it came back to risk on, and then we shifted back down to neutral over here, and now we're back in this risk off. And the other thing you notice in the indicators, it shows the months, but this is one of the measures. These are some of the measures that I use for risk on, risk off, and I include another video in this. I'm trying to think of the man. I think Keller. This was the video behind the indicator. My inspiration behind the indicator. The man name is David Keller. He's doing it on a simpler stocks video, stock charts TV. So it's 10 months ago. But anyway, I'll leave a link for his video in the bottom of this description as well. But this is going to be the end of the video. I appreciate you guys taking the time to listen to what I had to say. I hope it was helpful. I wish you the best. Stay safe and God bless. And if you haven't already, please like, subscribe.